Good morning, everyone. Welcome to this TreasuryONE weekly market update video. It's presented with myself, Wichard Cilliers, and our currency strategist, Cilliers. This morning, we're going to start off by looking at what's happening in the oil price market at the moment. We've seen oil jump tremendously in the last month or so, and it looks like we're going to have the first time we're going to have a close, weaker, stronger in dollar and oil prices for the last 4 months. What's your view currently on oil prices?
Yes, good morning. If we look at the oil price, then we have to translate that back to what happens in the Middle East with this whole Israeli-Gaza war. And after that, we had not seen massive and dramatic impact on the oil price. However, in December, ships started getting attacked in the Suez Canal, and that led to higher shipping prices in terms of insurance, longer routes for ships, but also had a direct impact on oil problems or constraint on oil supply, and that increased the price. So we had seen an oil price prior to the problems in the canal trading between a 74 and a 78 US dollar range. But after that, it had elevated, and it's now standing currently around the 81, 75, $82 per barrel. So I think what one can definitely say here is that we can foresee that oil prices will remain slightly elevated with a risk to the upside unless those problems gets addressed fairly quickly. It does not help that we've seen in the last week or over the weekend that American soldiers was attacked. 3 of them were killed, several were injured, and so that elevates the problem. So that obviously has an impact going forward on inflation and on interest rates. And I will just immediately say here that the problem with the increased shipping cost does not so much lie with South Africa, because our routes have not really changed. We go left of Africa or right of Africa, but it's more for the European markets and for the American markets. And now that we see the graph of the Federal Reserve decision tomorrow, we can see that from January onwards, that it's a fairly sharp increase in the outlook for what is expected of interest rates out of the Fed. Now, we can expect their meeting to focus sharply on the discussions on inflation and going forward, and how these shipping prices and increased oil prices will have an impact on that. Their economy, the fourth quarter figures came out very, very good for economic growth. The job figures is still looking excellent. And then obviously together with that comes the decline on prices if the economy is growing and consumers still spending. And apart from that, then with the shipping cost also going up, the elevated outlook for possible inflation could be negative and could lead to a Federal Reserve saying that we will see interest rates at these higher levels for a longer period, a rhetoric that is well embedded by the Federal Reserve Chairman, Mr. Powell. So we expect to be seeing a little bit more of that coming out. Only if they dovish will we see a change in direction of outlook for interest rates cuts, but I think that's a very slim chance at this point.
With the rand currently sitting at the 100 and 200-day moving average, it's currently awaiting what's going to happen from the Fed tomorrow night. Are you still happy to see that the rand is trading in that wider 18 to 20 range, 1820 to 1920 range, with any possible move waiting from the Fed?
You look at that little spike that it had in May, getting close to the 20 level, and then we go further to the September area where there was also that little bit of a spike, and in between it was touching that nice little red line of us, the moving averages lines and jumped up, then came down again, and now close there. But if you take those high points from May and you were to draw a little red line or a trend line there, it seems to be forming a little wedge here. So I'm happy with the current range. If we look at what is happening internationally with interest rates, etc., the longer at the higher elevated levels and interest rates only being cut in the second half of the year, I think our first half of this year is actually going to just focus around local factors like a budget and like the election coming up and possible coalition governments that could be leading to the rand breaking out of these narrow ranges that we're currently having, slightly above 1920, slightly below 1860 levels, but getting back into that range until such time as the Northern Hemisphere starts cutting interest rates in the second half of the year. And that could lead to interesting periods, because that could take the euro quite a bit higher, that could take the pound a little bit higher, and that will lead, as I say, then to a weakening of the dollar, strengthening of other currencies, including the rand. But if I say that, then it sounds that I'm advocating a stronger rand. If the euro moves up, if the pound moves up, if the Australian dollar moves up, in other words, all those currencies strengthen against the dollar, which includes the rand, it could mean that we're seeing a weaker rand against the euro, a weaker rand against the pound, and a lot of other currencies. And on a trade-weighted basis, it might not come out as a stronger rand, but rather as a weaker rand on a trade-weighted basis. Purely speaking, against the dollar, I think the second half could be the happy area for a rand appreciating in value against the dollar, but then, as I said, losing against the other currencies and still keeping it in an unhappy space in terms of trade-weighted movements of the currency. But for the moment, I'm happy with a trade range of 1860, 1920.
All right. Thanks so much for your time, Andre, again. We will continue to update our viewers out there with what's happening in the markets on a weekly basis. And we look forward to touching base with you next week.